Hey, what's going on YouTube? In this video, we're going to go over Tilray brands, ticker symbol TLRY. Company reported their Q1 24 earnings on October 4th, beat on their revenue, but missed on their EPS. Analysts have revised a couple higher and a couple lower for their next quarterly EPS revisions. And we come down here to their estimates by quarter, and we're not seeing any positive trajectory on their overall EPS going forward either. Year to date, this company is down 34.5% over the course of 1 year, down 53.25%. Company also has 15.4% short interest against it. So in their financial report, they recorded that their Q1 net revenue of $177 million was 15% growth year over year. They increased their cannabis market share position in Canada to 13.4%. And they also grew their Canadian cannabis revenue by 16.5%, international cannabis revenue by 37%. And for their fiscal year 24 guidance, the company is reiterating its adjusted EBITDA target of 68 million to 78 million, representing growth of 11 to 27% compared to fiscal year 23. The company also expects to generate positive adjusted free cash flow. Also, one thing to keep in mind with this company is it is making a significantly large amount of acquisitions over the course of the last 4 to 5 years. And each year they bought about 4 to 5 different companies, mostly within the same sector that they are in. They have expanded over a little bit into the alcoholic beverage industry now with acquiring 8 Beers and Beverage was one of their more recent acquisitions. Over here to our financial spreadsheet and to see how this company is performing. And we got a revenue, gross profit, and net income. All three, well, okay, we got a revenue, gross profit, basically flat. It appears to be literally no growth for the last 2, almost 3 years. It had some pretty decent growth, and then it's just flat. Our net income is not doing the same thing. Our net income is deaccelerating rapidly, and we are sitting at all-time lows for net income with all-time highs on revenue. Margins. We've seen significant margins in the past, but ever since they started doing mergers and acquisitions, their margins have decreased substantially. As we can see back here, they started doing mergers and acquisitions in 2019. Well, this is the same time when their margins took a big hit. And also in 2019, you can see here's where we started to see a significant decline in net revenues as well. So that could give you a pretty good indication that these mergers and acquisitions that this company is doing is not good for the company overall. It is impacting company in a very negative way. So last quarter, company did 25% of gross margins. Trailing 12 months, 21.5%. So we can still we're starting to see an uptick in margins right now. Overall, we're still sitting near all-time lows on margins. Net margins, though, just as bad. I mean, even worse, really. They've only seen positive net margins. They were starting to see some really good net margins actually up until 2019. And then once they started doing these mergers and acquisitions, it just crushed this company. I mean, 2018, they did 79.8% in gross margin, and they have not seen that since. Down here to our cash and short-term debt. Company has not quite enough cash to cover its current short-term debt, which then also means they don't have enough cash to cover their total debt also. Net income to free cash flow. Company does obviously a significantly large amount of negative net income, but they are still pulling off some positive free cash flows. Free cash flow, you can see right here, positive 16 million and negative 13 million last year. Capital expenditures are contracting nicely up to about $22 million in capital expenditures. So pretty decent there. Over to our 10Q on Tilray. We're on the balance sheet. Company's got $465 million in cash. We got cash equivalents, and marketable securities that we can add in also. And that gives us $465 million in cash. Also, one thing, side note, is goodwill here, sitting at $2 billion. So what goodwill is the amount that this company, in this case Tilray, pays above fair market value for an acquisition. So if an acquisition is $100 million, but they pay $200 million, $100 million goes over to goodwill because they overpaid for their acquisition. So basically on all their acquisitions, probably they overpaid for. So something to keep an eye on, obviously, because there's $2 billion worth of goodwill just within the assets. But obviously that is, if they were to sell all of their acquisitions tomorrow, they're probably not going to make that $2 billion back. So that is, in my opinion, not an asset. But we come down here to our liabilities. Company did 465 million in cash, $537 million in short-term debt, so they're currently net negative on cash. So this might indicate that they might need to raise more capital in the future. Unless they're positive free cash flow to cover the difference, then they might not need to. But if they're not positive free cash flow enough, they're probably going to end up needing to raise more capital, which will probably dilute shareholders more than they already have. So we come down here to our income statement. We did 176, basically $177 million last quarter in revs, up year over year. However, our cost of goods sold is up significantly year over year, which is contributing to a decrease in our overall net margins. And the question to me is, why do we see such a huge decrease in our margins, or not net margins, our gross margins? So jump into a different part of their income statement. It's more of a breakdown of each segment that they're invested into. And we see our cannabis, distribution, alcohol, wellness, and overall total. So cannabis right here, we can see their margin, their gross margin went from 51% to down to 28%. All the other margins, though, on the rest of their business actually increased, and all except for one, saw an increase on revs as well. So cannabis right now is obviously still growing revenue-wise, but they saw a significant decrease in their overall revenue. Now, the reason for that is right here. So Tilray entered into an advisory agreement with Hexo, and with that agreement, they earned revenues, and Hexo was another cannabis company as well. They earned revenues from that advisory agreement. So then that carried over to their margins, right? So they earned revenue from that. It didn't really cost them hardly any money. Obviously, they made pretty good money on it because it increased their margins from 28 to 51%. But now they have fully acquired Hexo, and now they don't get that advisory fee that they were accruing before. So that's impacting their margins even more. So like these business decisions that they're making, I just don't agree with whatsoever so far. I'm trying to find a reason to want to buy this company, and I cannot, I haven't found a reason to buy this company yet. So back to our income statement, total operating expenses of $78.5 million. That is up year over year from $70 million roughly. And then also another thing too is because of the higher interest rates, company last year was paying out $4.4 million per quarter on interest. Now they're paying almost $10 billion per quarter on higher interest. So another thing that is not helping their overall financials. Also, we are seeing significant dilution. This time last year, we were sitting at 575 million shares. Now we're at 691 million shares. And down to the cash flows. So we have a total net loss of $56 million. We get to add in, subtract out a few other things. We got amortization. We get to add in stock-based compensation. I'm kind of shocked it's only $8.2 million. I'm surprised it's not much more. And then down here, overall, we have negative $15.8 million cash from operations. So we got 15.8 minus CapEx, which this would be just a plus CapEx of negative $20 million in free cash flow. So that kind of tells you this is over the last 3 months. So this company has burned $20 million in the last 3 months. Obviously, we saw positive free cash flows from the trailing 12 months, but that's including 3 other quarters. So they have seen positive quarters, and their overall in the trailing 12 months are positive free cash flow, but that net income or that gross margin hit to their cannabis sector is killing this business right now. So that kind of tells us that they will need to raise more money in the future because they're burning through $56 million per quarter on the net income, plus short-term debt that is due throughout the year. So they're going to have to probably pay or find a way to raise more capital in the future. Over to the comps, we have 2 other companies to compare to, and we can just look on the stock chart on all 3 companies. We can just see what the cannabis sector is doing overall, and it's not looking very good. So you can even see all the red flags within the business sector here. Every single company is diluting shareholders significantly. 23%, 52%, 20% over here as well. When we come down here to our comparison charts, we can see market cap to revenue, and Tilray has the best market cap and revenue on the board here. However, it has the worst net income of the board as well. Gross margins, best gross margins. However, operating and profit margins, not looking very good. Obviously, the best profit margins, but man, these are really bad. This industry is probably This is, in my opinion, this is an industry probably to stay away from. Free cash flow, positive, barely free cash flow. The other two, not even close. Return on invested capital, same thing. Actually, CGC is not too far from at least turning somewhat of a positive return on invested capital. And earnings yield, not very good either. So overall, these numbers look very bad. Over to our calculator spreadsheet. Because this company is a negative earnings per share, there's only one actual calculator that we can use because they just turned positive free cash flow. That'd be the only one that we can use for an actual valuation metric. So P/H valuation, not valid. Multiples, not valid. Our PE, we can take our market cap minus cash, add in debt, divide by cash from operations. It would take this company about 30 years to earn its current market cap. Price to book, we know there's about $2 billion worth of assets on goodwill. So in my opinion, price to book is not a very valid 5-year or current price to book either. It's not one that I would go off of. Graham's valuation, also negative. Discounted cash flow, though, this is the only one that we can utilize. Currently, company is just turned positive free cash flow. So assuming they can continue and to grow their free cash flow, which it seems like they're forecasting a little bit in their fourth quarter, we'll have to wait and see. If they do, I could see them should easily be able to increase their free cash flow growth rate at about 45%. Assuming they can continue this growth rate like that. You know, they went from negative 211 million to positive 13 or negative 13 up to positive 16. Growth rate is slowing down there, but if they can continue this momentum, we could potentially see some pretty decent growth rates on their free cash flow. So if that's the case, I gave them 45%, might be a little generous, but that gives them $3.56 per share. Rule 72, again, negative EPS. We're just so far away from a positive EPS. I can't really, you just really can't adjust that, in my opinion, to make this, to figure out a fair market value on this company right now. Currently trading at $1.80. Our fair market value is just going to be our DCF, which is at $3.56. Analysts have a price target of $3.50, so I'm going to have to probably assume analysts, the reason why they have such, we're basically at the exact same number, is they're looking at DCF as well and is assuming maybe a 45% growth rate also. And over to our stock chart here. Well, there's nothing really good to see here either. We can see the company rallied up to I guess $300 per share once upon a time, and just never saw it back. Tried rallied again in 2021 up to $67, and it's just sold off ever since. And it makes sense. The company's not, the financials on the company don't look good. In my opinion, the story isn't that great either because there doesn't seem to be any consistency within the business. They're just acquiring businesses left and right. And they don't seem to be focusing on their main core business right now. So I think overall, I think this company is not very well ran. I don't know if they can turn things around before it's too late. I mean, this company is still locked in a downtrend, depending on how far back you want to draw a trend line. Eventually, you can probably maybe go back to like there. We're kind of creating a bit of a wedge, sitting at near support right now, and you could maybe draw it up to like something like that, creating a little bit of a wedge here. So I don't know. In my opinion, I don't. This is one that I would try to. I would stay away from. This is one that just does not interest me whatsoever. Again, I tried looking for a reason to find a way to pique an interest and want to maybe pick up some shares on this one, but I don't see any reason why to buy this one right now, with what they're doing and how they're doing it, and their financials just don't look good whatsoever. But that is it on Tilray. If you found value in this video, drop a like, subscribe, comment. We'll be back later with another Stock Nails video.